Flint West, reporting from the macro frontier. Why Powell won't cut, the $7 trillion trap beneath the Fed. There's over $7 trillion parked in U.S. money market funds right now. This capital earns around 4.25% thanks to the Federal Reserve's overnight reverse repo facility and short-term interest rate policy. That rate is controlled directly by Jerome Powell and the FOMC. This isn't idle cash. It includes capital from pension funds, retirement accounts, and institutional treasuries. These entities desperately need a safe, steady yield, especially after a decade of near-zero rates. With 4 to 5% available from money markets, they finally have it, risk-free income without touching the stock market. This setup is a modern form of narrow banking, safe yield, no risk, no velocity. The money stays out of circulation. But here's the catch. If Powell cuts rates too soon, say from 4.25% to 2.25%, he triggers a stampede for yield. That $7 trillion won't sit still. It'll rush into equities, bonds, real estate, private credit, anywhere but cash. The result? A flood of capital into the broader economy, reigniting asset bubbles and potentially setting off an inflation bomb. And once that genie's out, it's hard to contain. The Fed would be forced to hike rates again, possibly even higher than today's levels, risking credibility, chaos, and a repeat of the 1970s Arthur Burns debacle. Powell is determined to avoid that mistake. So no, he's not cutting rates anytime soon. Not because of mortgages, not because of politics, but because $7 trillion is sitting on a hair trigger. For more context, Jerome Powell has little to no control over long-term interest rates. Those are set by the bond market. The 10-year and 30-year Treasury yields, which drive mortgage rates, are elevated due to global de-dollarization pressures, persistent U.S. fiscal deficits, Trump-era tariffs and inflationary policy carryovers, gold gaining traction as a neutral, sanction-proof alternative to Treasuries. So, when you see mortgage rates at 7%, don't blame the Fed's short end. Blame the long end and the world's loss of faith in U.S. debt. Flint West, signing off from the yield curve's edge, where $7 trillion sits frozen and one wrong move melts the whole damn thing. Stay frosty.